and is projected to have a profound effect on the economy at home and abroad. Would you agree with her statement, and can you give some examples of how you see that to be true?
Well, I think climate change is a very important issue, and if you'll allow me, I will start by saying that the nation's policy on climate change really needs to be set in the first instance by you, elected representatives in the House and Senate, and then by the administration through the agencies that Congress has created. Our role is really that of assuring that we are using our powers to carry out our mandate in supervising financial institutions to make sure that they're resilient to all risks, including that of climate change. That's what we're doing.
And can you explain the steps the Fed will be taking over the next 18 to 24 months to ensure the financial system can deal with the future financial and economic risks posed by climate change?
Yes, so we're doing right now a great deal of outreach and research and consultation. And by the way, the larger and medium-sized banks are doing the same thing. It is really time to have this, to do this work and to try to understand. Climate change is a longer run issue to deal with, and you will see that the financial institutions themselves are very focused on understanding how it will over time affect their business model. We're looking at the same thing from the standpoint of a regulator and supervisor. So research and basic work to lay out a framework, which will take some time, but it is time for us to do that.
Thank you. I yield back.
Thank you. The gentlewoman from Missouri, Mrs. Wagner, is now recognized for 5 minutes.
Thank you, Madam Chairwoman and Chairman Powell. It's good to see you again. Thank you for being here today. Thank you for all that you and the Fed have done during this unprecedented pandemic. Under the Fed's average inflation targeting, you are looking for inflation to be, and I quote, moderately above 2% for some time to make up for undershooting inflation in the past. What does moderately above 2% for some time mean specifically? And why do we believe this is achievable if the FOMC's 3-year projections for quite some time now have been forecasting inflation, in fact, of 2% or less?
So on the first part, what does moderately mean? We don't have a formula, and we're not going to have a formula. The sense of it, though, is that we want inflation to average 2% over time. And the reason we want that is that we want inflation expectations to be anchored right at 2% and not somewhat below 2%, which is arguably the case now. That's really how we're looking at it. In terms of can we get there, I'm confident that we can and that we will, and we are committed to using our tools to achieving that. The 3-year time frame is actually an arbitrary 3-year time frame chosen by us, and we're just being honest about the challenge. We live in a time where there's significant disinflationary pressures around the world, and where essentially all major advanced economy central banks have struggled to get to 2%. We believe we can do it, believe we will do it. It may take more than 3 years, but we'll update that every quarter. We update that assessment, and we'll see how that goes.
Thank you, Chairman Powell. I know you were asked a number of times by my colleagues in the Senate yesterday whether the Fed intends to extend the exclusion of low-risk assets such as Treasuries and reserve balances from the supplementary leverage ratio. I strongly supported the agency's decision nearly a year ago to make this exclusion in recognition, I think, of the fact that banks were receiving just an unprecedented amount of new deposits, largely as a result of the Fed's actions that continue to put pressure on leverage ratios. You indicated, sir, yesterday that the Fed is still considering whether or not to provide an extension. Do you agree that the exclusion proved to be an important tool to preserve liquidity in the Treasury market?
Yes, I do agree to that. But I mean, we're just looking at this. I don't really have anything for you on that decision. That I didn't have anything yesterday, as you pointed out. So we're looking at that, and we know when the deadline is, and we're working on that, and we'll come forth with something relatively soon.
Well, I hope it's relatively soon, Mr. Chairman, because given that we're still considering new stimulus and other accommodations to continue economic recovery, I'm concerned, and I'm wondering if you are concerned about that arbitrarily removing the exclusion on March 31 could put additional pressure on the Treasury market. I mean, making sure that the SLR is extended, I think, is very, very important as we continue this recovery. And as I said, as further stimulus actions are considered and put into law. March 31 is nearly upon us, Mr. Chairman.
Yes, it is.
Oh, come on. Surely you can talk to us a little bit more about how important that was over the past year in terms of our banking industry and to keep liquidity in the market, given the large number of deposits that were extended to our banking community.
I'm just going to say that we're having discussions on it right now and internally here, and I really don't want to go any further than that. I'm sorry, but we're making a decision. We're considering it, and when we have a decision, we'll come forward. I'm sorry.
I respect that, and I look forward to that decision. And Madam Chairman, I yield back. Thank you.
Thank you. The gentleman from California, Mr. Sherman, who is also the chair of the subcommittee on investor protection, entrepreneurship, and capital markets, is now recognized for 5 minutes.
Thank you. Mr. Chairman, it's good to hear about your Fed Listens events, but I assure you your best Fed Listens event is right here today. You will not find 50 people in better touch and more representative of the 320 million Americans. I've grown old serving on this committee, and I've seen your predecessor come here, and Republicans attack them for what they regarded as a too expansionary monetary policy, whether the expansionary system be the traditional or the relatively newfangled quantitative easing. It's good for me to live long enough to see that many of the Republicans are moving in our direction toward the need for a somewhat more expansionary monetary policy. And I would hope that you would be looking at 2.25% rather than 2% as your target. I also commend you for the quantitative easing. It has allowed you to remit to the federal government $50 to $100 billion in each of the last several years. And so those who criticize your big balance sheet have been unwilling to identify which taxes they would raise in order to make up for that lost revenue. Also, your quantitative easing big balance sheet approach is the only tool you have to influence long-term interest rates, which I think are much more important to our economy, since you have to borrow long-term to build a factory or build a business. And I prefer monetary policy to an expansionary fiscal policy, because all of your tools reduce the federal deficit, and all of our tools increase the long-term federal debt. Want to focus your attention on LIBOR. It now appears as if the LIBOR index will continue to be published till June of 2023. It's almost disappointing to get a reprieve, and that it will reduce the pressure on us to actually solve this problem. But it does give us more time. And there is, of course, the Alternative Reference Rates Committee, ARC, and we have legislation to facilitate how to deal with what will be $2 trillion of existing contracts that don't have backup language. I wonder if you can confirm for me, in your view, is it necessary to have federal legislation to have a smooth transition after June 2023 when LIBOR is no longer published?
Yes, we think it will be. As you know, many LIBOR contracts are going to run off before then, but there'll be a hard tail, as we say, and we do think federal legislation is the best answer.
And there are those who think that that the private sector can just invent a synthetic LIBOR and that would solve the problem. Is that as good a solution as federal legislation?
No, federal legislation creating a path for a backup would be the best solution, we think.
Thank you. Now I want to move to something that we've talked about before, and that some will regard as a small issue, and that is the system for avoiding wire fraud. When we've talked about this earlier this month, where usually it's somebody trying to buy a home the first time ever, when they'll remit $10, $20, $30, $50,000 for the down payment. It's their life savings. And they're tricked into wiring the money to the wrong account number, and they lose it forever. Now you're developing the new FedNow system, and your bureaucrats have told us that they don't want to engineer that system to avoid this tragedy that occurred, as I said, affecting $150 million just last year. That they don't want to do the really simple thing of just saying that when you remit money, you identify not only the account number you're sending it to, but the name of the person you're sending it to. And I know your bureaucrats will tell you they don't want to do it. I wonder whether you'll go back to your agency and get personally involved and push them to avoid this tragedy. I don't think your successor should have to, face people at the next Fed Listen session, maybe 10 years from now, who have lost their homes as a result of this. Can you commit to getting personally involved and having a system that will hopefully protect homeowners or home buyers?
So I think, as you know, we've looked carefully at this and concluded that payee matching is not the best way to do it, and there are just problems in the U.S. system, but we have other ways to do it well. I'll be happy to go back and revisit that, though.
If there's another way, let me know what it is, because your staff just tells me they don't want to.
The gentleman's time has expired. The gentleman from Oklahoma, Mr. Lucas, is now recognized for 5 minutes.
Thank you, Madam Chair. And Chairman Powell, you know I have a tendency to focus on those things that affect my people back home up and down Main Street and across the 3rd District of Oklahoma. So let's discuss for a moment. When you were last before the committee in June, you noted that the U.S. banking system has been a source of strength during the pandemic. The Fed's monetary policy report released on February 19 reaffirmed this point, stating that institutions at the core of the financial services system remain resilient. Do you continue to believe that banks are a source of strength? And will you elaborate both on what that means for the economy and for banks' abilities to lend, yes, absorb losses potentially too, and provide liquidity in distressed markets?
Yeah, so we've, we spent, and the bank spent 10 years in a strengthening process, higher capital, better risk management, higher liquidity, all of those things. And then we received a world historical sized shock in the form of the pandemic. And I think, essentially close to a year into it, almost exactly a year into it, we see so far, what we see is that our banks have held up quite well, and their capital, the big banks' capital has actually increased over the course of the last year, while they've also taken $100 billion plus worth of reserves against losses. And so they are able to keep lending. They're not a source of weakness. At the beginning of the pandemic, they were very important because they did absorb that huge flow of deposits, and they made all of those loans as companies pulled down their lines of credit. Now, those were paid back early on, but at the very beginning, when it mattered a lot, they were a source of strength. So I think all of that is right. We've always got to continue to be vigilant on those things, but a first draft of history is that the banks are strong. And I would say the same for small and medium-sized banks as well, have generally held up well, there are going to be issues, and as we come out of this, there are going to be businesses that fail and there will be losses, but it's quite different, a very, very different situation than we had after the global financial crisis.
Absolutely. And Mr. Chairman, let's discuss for a moment a topic that's very important, not only to me, but my friends in the majority on the Financial Services Committee. The national unbanked rate has been falling steadily for the past decade. And since the last calculated in 2019 sets at about 5.4%. Still, this represents more than 7 million U.S. households without a checking or savings account. Unfortunately, the COVID-19 pandemic is likely to contribute to an increase in the rate of unbanked households. Chairman, what would you suggest to reduce the adverse impact on the unbanked and underbanked in the aftermath of the pandemic to ensure that no one is left out of the economic recovery?
I think it's a serious problem to address. We tend to address it through our community affairs and efforts to make sure that, fair lending policies and things like that. I also think that there's more that Congress can do, I'm sure, to assure that people have, education around financial matters. And the other piece of it is, there are people at the lower end of the income spectrum who are living hand to mouth. We need a strong recovery. We need continued support for monetary policy, and we'll be providing that as well.
One last question, Chairman, and it impacts the ability of every Main Street to function. According to the FDA, the United States administered more than 63 million doses of COVID-19 vaccine. Chairman Powell, can you expand on how important to the economic recovery or how dependent the recovery is on ramping up that manufacturing and distribution?
Yes, this is the weakness we see in our economy now is unusually concentrated in a set of industries that involve people getting really close together. Hotels, restaurants, travel, entertainment, all of those places. And that's millions of people who aren't working and businesses that may have been in business for generations going out of businesses. That's what that is. And the way to get after that is through by successfully, decisively bringing the pandemic to an end as soon as possible. That's the single best growth and economic and prosperity creating measure that any of us can undertake. And that is the vaccination. It's continuing to observe social distancing and wearing masks. Hopefully we're on that road now. And if we are, we're going to see, there's grounds for optimism in the second half of the year for the economy.
The gentleman's time has expired. The gentleman from Texas, Mr. Green, who is also the chair of the subcommittee on oversight and investigations, is now recognized for 5 minutes.
Thank you very much, Madam Chair, and I thank the witness for appearing. I'm always honored to have him here before the committee. My question has to do with the State Small Business Credit Initiative. This is an initiative that was started under a Republican administration. It has served us exceedingly well, and the chairwoman, with her insight and foresight, has expanded this program to make sure that it covers women and people of color to a greater extent. We're talking about having this initiative be funded with $10 billion, and this is in the COVID package. And this $10 billion can drive up to $100 billion of private sector investments in these small businesses. States would be required to submit a plan, as well as other jurisdictions, on how expeditiously these funds can be delivered to help small businesses respond to and recover from the pandemic. A plan to encourage participation of MDIs, minority depository institutions, as well as CDFIs, community development financial institutions, would also be a part of this. Mr. Chairman, my question to you is simply this: how important is it that small businesses receive these capital investments? They sometimes find it exceedingly difficult to acquire funds of this type, the type that we have in this package. How important is it that these funds during this pandemic get to these small businesses?
Well, Small businesses are under a lot of pressure in this at the current time, more so than many of the larger businesses that had resources to get through this. I would say MDIs and CDFIs are very important channels for reaching them. It's not appropriate for me to take a position on this particular provision and its inclusion in the in legislation. But I would just say that it is important for small businesses, and you mentioned MDIs and CDFIs. We, as you know, we work very closely with those organizations and think highly of the contribution they make to our economy.
Yes, sir, and I concur with what you said about working closely with them. I happen to be aware of some of your good works. The community banks, as you know, I'm very much concerned about them, and some of them are on the margins. And this type of assistance to some of these smaller banks can be of great help to them. I don't want you to comment on a specific bank or specific banks in general, but I am concerned about the need to maintain these institutions that have a niche. They have a clientele that somehow and sometimes will not be met. Their needs won't be met if they don't have these institutions that are in the communities. Have you found that it's good to have these institutions in these communities where the need is not always met?
Yes, I mean, we think community banks are a very important part of the fabric of our society, and we see them under longer term secular pressures. They've been declining, and we don't want to do anything that adds to that through regulatory burden. And actually, we've got a subcommittee. We have a community banker on the board of governors, and we try to do everything we can to not be part of the problem, because people are leaving small towns and moving to cities and things like that, and that is putting pressure on rural community banks. But overall, they know their communities, and we want them to operate safely and soundly and successfully in their communities.
Well, thank you very much. I have very little time left, so what I would like to do is simply acknowledge the chairwoman for helping us to get this $10 billion into the COVID package. Ms. Beatty also helped us to modify it along with one of my Republican colleagues so that the very small businesses will get some help. There are small businesses and then there are very small businesses, and we don't want to leave any of them behind. So, Madam Chair, I thank you very much for the opportunity to ask these questions. I yield back.
Thank you very much, and I appreciate your comments. I will now recognize the gentleman from Florida, Mr. Posey, for 5 minutes.
Well, thank you very much, Madam Chairwoman. I'm pleased that we have this opportunity to hear Chairman Powell's semi-annual report on the state of monetary policy. We've all shared quite a year since February 2020 hearing.
Chair Powell addressing a broader range of topics than yesterday, including a digital dollar and climate change, but for the most part, reiterating his comments from yesterday about employment, adding that it might be possible that they don't reach their inflation expectations for the next 3 years. By the way, Dow's gone green. I think we have exceeded the all-time high. Boeing up 5%, year-to-date high. Disney's hit 200. That's an all-time high, and oil at 63. Squawk Alley starts in a minute.
Yeah, Carl, Powell, just now, having been asked if there's a risk of overheating the economy with that big stimulus bill coming down the pike, he said the Fed expects inflation to move up, and also there could be a surge in spending as the economy reopens, but he does not see that as a persistent long-term inflationary problem. And he repeated his dovish commentary on the outlook for policy. Bond markets, though, not hearing it quite the same way at first, and then maybe reconsidering. Take a look at the trade in the 10-year, up above 140 this morning as before Powell started speaking, and then while he was speaking, then it came back down the other way. Powell also making additional comments on the prospect of a central bank digital currency.